While most investors scroll past, some of the world's largest hedge funds are quietly loading up on a single stock. Millions of dollars are moving. Almost nobody notices. Why now? Why this stock? What's coming next could change everything. Last year, one hedge fund quietly bought 5 million shares without triggering any headlines. By the time the news leaked, insiders were already miles ahead. But there's a deeper story here, one that most investors will never see. And here's where most people get it wrong. They only see the stock price, not the machinery behind it. In another city, a portfolio manager spent weeks quietly building positions. He placed trades across multiple accounts, across multiple countries, all designed to fly under the radar. By the end of the quarter, he controlled a position worth hundreds of millions, almost no one noticing. This story isn't just about one fund. Decades ago, similar strategies were pioneered by legendary investors who understood something almost nobody else did, and the lessons they left behind are still being applied today. What's about to happen next is where ordinary investors start losing ground. The company began with outsiders, people who weren't part of elite financial circles. They had ideas, determination, and a vision for a market overlooked by almost everyone else. Their first attempts to secure investment failed. Early prototypes stumbled, but every mistake revealed hidden opportunities. Partnerships dissolved, leaving them lean but sharper. And here's the subtle truth. Failure, in the right hands, is a blueprint for dominance. The 1980s and 1990s were volatile. Interest rates, inflation, and trade tensions created both danger and opportunity. Emerging markets were undervalued, ignored by mainstream investors. Currency fluctuations and interest rate shifts created hidden leverage. Savvy hedge funds began noticing trends invisible to most analysts. A young portfolio manager noticed a company quietly acquiring patents. While the market dismissed them, he began buying small positions. A decade later, those early moves would generate exponential gains. Accumulation isn't numbers on a screen, it's perception, timing, and psychology. Funds anticipate market sentiment, media narratives, and investor psychology. Each small move compounds invisibly over time, unnoticed until the tipping point. Retail investors often unknowingly reinforce these patterns. And here's the point most investors miss. The market reacts long after the real moves have been made. By the late 1990s, the company grew quietly. Analysts noticed revenue increases but missed the underlying strategy. Early stock adopters saw modest gains, thinking the market was random. Hedge funds had already established controlling positions. Corporate decisions, acquisitions, and patents shaped market perceptions subtly. A hedge fund acquired 3% of the company via derivatives and swaps. Publicly, the stock appeared stagnant. Privately, the fund influenced perception to create controlled price movements. Retail investors unknowingly supported the strategy. By the mid-2000s, hedge funds refined accumulation. Derivatives, swaps, and options allowed silent control. Cross-border trades evaded single regulators. Trades were timed with news cycles and sentiment for maximum gain. What seems random is often a perfectly orchestrated dance of perception, timing, and psychology. Even subtle strategies aren't without tension. Managers disagreed on leverage and timing. Leaks caused minor volatility but were exploited for further gain. These moments reinforced control without drawing headlines. Human behavior drives markets as much as numbers. Herd mentality ensures retail investors follow late. FOMO drives bubble-like behavior before fundamentals justify it. Behavioral economics explains how a few can profit massively from many. In 2005, a retail investor bought after glowing reports. He didn't realize the reports were subtly influenced. As his gains were modest, the fund had orchestrated the trend months in advance. Offshore accounts, derivative instruments, and cross-border trades kept positions hidden. Small controlled leaks tested market response. Global economic factors, currencies, interest rates, emerging markets, amplified profits. Hedge funds identified undervalued tech sectors in Asia. Quiet acquisitions via derivatives multiplied in value over 2 years. Retail investors had no idea their behavior was being anticipated. Even sophisticated strategies face risks. Junior trader leaks caused temporary volatility. Funds exploited the leaks for additional gains. Public misattributed fluctuations to ordinary market forces. The unsettling truth: markets are often manipulated invisibly, and the vast majority never see it. Human psychology, greed, fear, and overconfidence dominate investor decisions. Herd behavior ensures retail investors act after patterns emerge. Understanding behavior allowed funds to profit quietly for decades. A fund tracked early social media and blogs to predict retail actions. Small spikes in conversation drove minor stock movements, which reinforced the trend, unseen by mainstream media. Most investors look at charts and financial statements. But the real play happens behind the scenes. Hedge funds track patterns invisible to the public eye, microtrends in media, analyst sentiment, even social chatter. A single leak of information, even unintentional, can create ripples that amplify profits. Timing trades with news cycles is an art, buying moments before optimism peaks and selling just before panic sets in. Subtle signals, like a CEO's statement in a minor interview, can trigger micro-movements worth millions when anticipated correctly. Here's where it gets fascinating. The moves that seem random are often choreographed to perfection. Between 2010 and 2015, one hedge fund quietly positioned itself to benefit from a series of small acquisitions. The acquisitions appeared routine to most investors. Privately, the fund had calculated how each merger would improve market perception and influence stock price. By the time the public noticed, the hedge fund had already secured significant gains. Financial success isn't just about strategy, it's about understanding people. Retail investors react emotionally, not rationally. FOMO and panic create predictable patterns, exploited by those who understand them. Institutional investors anticipate these behaviors months, sometimes years, in advance. A small social media post in 2016 caused an unexpected spike in retail buying. Hedge funds had already anticipated the move and positioned accordingly. By the time the market reacted, the profit had already been secured quietly. Markets do not exist in isolation. Global events, political unrest, interest rate changes, and currency fluctuations create opportunities for those who can see beyond the obvious. A sudden rate cut in one country can inflate valuations in another if anticipated correctly. Emerging markets often hide undervalued assets ignored by the mainstream. Strategic timing across borders multiplies profits in ways most investors will never detect. And here's the secret few understand. Geography, timing, and psychology combine to make invisible profits massive. Even carefully executed strategies can flirt with controversy. Some hedge funds influence sentiment subtly, without ever breaking explicit rules. Leaks, rumors, and analyst commentary can be nudged strategically. By the time regulators notice patterns, the profit has often already been secured. A tech company's stock rose 12% over 2 weeks due to a carefully orchestrated series of small trades, news mentions, and public optimism. Retail investors attributed it to innovation and growth. Behind the scenes, a handful of funds had anticipated every micro movement. The result? Millions in profit quietly accumulated without alerting the broader market. Long-term success comes from observation, patience, and understanding subtle patterns. Quietly tracking behavior over months or years is more powerful than chasing headlines. Patterns repeat. Human psychology, market sentiment, and institutional moves create predictable outcomes. The real winners play the invisible game. If you're waiting for the obvious signal, you're already late. Knowledge is more valuable than action without insight. Small, invisible moves create massive outcomes over time. Understanding psychology, strategy, and global factors is the edge most investors lack. The world of finance is silent, invisible, and relentless. Billions move without headlines. Perception, timing, and psychology rule. If you understand the patterns, you can see what most never will. Knowledge, patience, and observation are the ultimate currency. And now that we've reached the end of this story, take a moment. Let everything sit. Because behind every event we just walked through, there's still more unfolding. The world of money never sleeps. If you want to keep seeing what others miss, if you want the deeper layers, the hidden incentives, the quiet moves that shape everything, you're in the right place. So here's what you can do to stay ahead. Subscribe to the channel if you haven't already. That way you never miss the next investigation. Share this video with someone who thinks about money the way you do. Someone who wants to understand the world, not just watch it happen. Drop a comment below and tell us what part of this story stood out to you, or what topic you want us to investigate next. We read everything. And of course, if this breakdown opened your eyes, hit that like button, not for the algorithm, but because it tells us these long, deep dives are worth making. So keep your mind sharp, stay curious, and don't stop questioning the things most people take for granted. Thanks for watching. This is Money Hub, and we'll see you in the next one.